Hi, this is Ratan Gupta from Knowledge Varsity. Welcome to today's reading on debt securities. We are covering reading number 60, features of debt securities. Okay. This content is brought to you by Knowledge Varsity. We conduct live and online classes for CFA program. So in this reading, we'll be discussing about what are the different type of bonds and their features. Okay. So whenever like a company issues a bond, it issues a contract. In that contract, it specifies the rights and obligation of both the issuer and the holder. Okay. So this contract is called as indenture. Okay. Now, there are some restrictions on the issuers, okay, which are specified in this indentures. So there are restrictions as well as obligations. These are called as covenants. The covenants can be both affirmative and negative. Okay. The affirmative covenants are the covenants that the borrowers say that it will perform. Okay, so these are borrowers conditions that they have to provide this. Okay, some of these are like maintenance of financial ratios, that is they have to maintain this debt to equity ratio or interest coverage ratio. These are the affirmative covenants. Similarly, there are some negative covenants, that is they are providing some restriction on the borrower, restriction or prohibition on the borrower. These are like you cannot sell some asset, you cannot borrow above some limit. So these are the negative covenants. Okay. Now each of the bond that is being issued, they have these covenants or indenture. Okay. Now we'll see like what are the different type of bonds. Before covering the different type of bonds, we'll cover like what a bond has. A bond has what is called as coupon. Okay. It has a coupon, it has a face value, it has a time to maturity, that is like at what time the bond will mature, that is it will cease to exist. Okay. So as we saw in time value of money, you can find out the present value of the bond and then you will have the price. Okay. So bond has coupon, face value, time to maturity, price. Okay. Depending on how these are structured, you can have infinite bond types. Okay. The simplest type of bond is straight bond or called as plain vanilla bond. Okay. So this straight bond has coupon, it regularly pays coupon. The coupon can be paid annually, semi-annually, monthly. It has a face value, it has certain time to maturity. Okay. Okay, it is simplest type of bond. Okay. Then next you have zero coupon bond. Okay. By the name it suggests that the coupon of this bond is zero. So this coupon is zero for this bond. Okay. Now these bonds are also called as discount bonds because these bonds are issued to the investor at a discount to the face value. So let's say if the face value of a bond, of a zero coupon bond is $100, it would be issued at a price which is lesser than this 100. So it can be issued at $70. Okay. So what happens is at the time of maturity, the investor or the bond holder will get $100. So he invested $70, he will get $100 from his investment. So the earning that will be there will be $30, and that will be the interest that the investor has received. Okay. Another type of bond is step up note. Okay. In this what happens is the coupon rate will be increased. It can happen once, it can happen more than once. Okay. But there is an increase in the coupon rate. Okay. There are some bonds which do not pay coupon for a specified period of time. That is, they are called as deferred coupon bond. So it is a combination of zero coupon and a straight bond. What happens is for a certain number of years, so if the bond is for let's say 10 years, for let's say for 3 years it will not pay any coupon, and after the at the end of the third year or fourth year it will pay all the coupon at bulk. Okay, so that is a bullet payment it will do. And the coupon which are deferred will be compounded, that is interest rate will be charged on those coupon which have been missed. Okay, after the payment of those deferred coupon, the bond will start behaving like a straight bond. So from here it will start behaving like a straight bond. Okay, then there are a category of bond which are floating rate bond. Here, like if you see, straight bond had a fixed coupon. The coupon was not changing. Zero coupon bond did not have any coupon. Step up note used to increase the coupon at some point. But the floating rate bonds are those bonds in which the rate is not fixed but it is floating. We'll see the category of this bond. So these bonds are also called as floaters. Okay, there is usually a reference rate on which the floating rate is decided. Usually it is LIBOR, that is London Interbank Offered Rate, is used as the reference rate. The coupon rate for the bond is this reference rate plus or minus a margin or the markup on that. So if the LIBOR is 5% at one point of time and the margin is 0.5%, okay, so the coupon rate for that period would be 5.5%. Okay, now this LIBOR can change. So if the LIBOR changes from 5% to 6%, the coupon will be this 6% plus this 6.5%. The coupon will become 6.5%. Okay, so the coupon rate is floating or is changing depending on the reference rate. So the reference rate has changed from 5 to 6, the coupon has changed from 5.5 to 6.5. For some investors, it can be, margin can be reduced from the reference rate also. Okay, in this case what was happening was the rate was increasing, reference rate was increasing, the coupon rate is increasing. But we can have floating rate bonds which are inverse, that is if interest rate increases, the coupon rate is actually decreasing. So in that case the coupon rate can be stated like this, 10% minus the reference rate. Okay, so the coupon rate is 10% minus the reference rate. So when the reference rate was 5%, the coupon rate was 5%, 10 minus 5. But when reference rate becomes 6%, the coupon rate has become 4%. Okay, so here the coupon is decreasing when the reference rate is increasing. It might happen that the reference rate can become 10%. In that case the coupon rate will be 0%. Or it can happen that the reference rate can exceed 10%, coupon rate can be negative. Usually that does not happen, but companies or the issuers or the bond holders, they agree upon that interest rate cannot become negative. There is another way to agree upon some specifying some interest rate, and that is through agreeing on what is called as cap rate and floor rate. Okay, so a company, issuer can issue a bond and specify that the cap rate is 8%. That is, the coupon rate in no case can become more than 8%. So in this case, if the reference rate become, let's say 9%, so the coupon rate should have been 9.5%. But if the issuer has specified that there is a cap on the rate of 8%, that is a cap on the coupon to be 8%, coupon cannot become 9.5%. It has to be 8% only. So a issuer can specify a cap rate. This cap rate is helpful for is benefiting the issuer, right? Because if the rate had become 10%, he should have been paying 10.5%, but it is only paying 8%. So cap is benefiting issuer, but it is against the interest of the bond holder. Okay. Similarly, you have one more thing as floor rate. That means if the coupon rate has become, let's say 1%, okay, so in that case the interest that is to be paid, that the coupon to be paid by the holder is 1.5, by the issuer is 1.5%. But a borrower can specify that I do not want any coupon below 4%. So he is specifying a floor rate on the bond. So this is the floor rate, that is coupon cannot be below 4%. Okay, so a bond can have floor and it will benefit the holder, but it will be against the issuer. A bond can have both of these, and combination of both of these is called as collar. That is, you can have a cap as well as you can have a floor. Okay. Now there are some bonds which are linked to the interest, linked to the inflation rate. So these are called as inflation indexed bond. Okay. These are linked to the consumer price index. The inflation is being calculated from this consumer price index. Okay, now the bonds can be traded in the market. Okay, so when they are trading in the market, there has to be some price for it. Okay, there are, depending on the way the bond price is quoted, it can be deemed as a full price bond or a clean price. Okay, so let's first see what are these prices and how these come. So let's take a 2-year bond, okay, paying annual coupon of 10% and a face value of 100. Okay, so it pays a coupon of $10 and then a face value of $100, okay, in the next year. Okay, suppose some person bought the bond at time t equal to 0 and it want to exit the bond after half year. So that is after 0.5 time period he want to exit the bond. Okay, so he should be getting the interest that is accrued on the bond over this 6 months. Okay. Okay, so if a bond is traded considering the accrued interest over this period, it is called as the full price. Okay, so this period rate is called as accrued interest. Okay, a bond which is traded considering this accrued interest, it is called as full price. If a bond is traded without considering this accrued interest, it is called as clean price. Okay, I am saying that traded, that is the price that you will see on the exchange or on the quotes. Definitely it is sure that the person who is buying the bond will have to pay accrued interest to the seller, because the buyer will get the bond on this day. Okay, it is not the seller who will get this $10. So but the buyer is only entitled for the interest that is for this period, which is $5. So he should give back the $5 to the seller. So the price should include the accrued interest. But usually what happens is, in US, in the exchange, the quotation that the bond dealers give are the clean price, because it is very easy to find out. If you want to price the bond at this point of time, what you will do is you will discount this $10 at whatever is the interest rate for half year, and you will discount again the $110, okay, for 1.5 year. So you will say that is the present value of the bond, or this will be also the clean price of the bond. Okay, and on top of that, whenever the trade happens, they will add accrued interest to come up with the full price of the bond. Okay. Okay, sometimes there are bonds which will pay interest as well as principal regularly. These bonds are called as amortizing bond. Most of the consumer loans are amortizing bonds. Okay. Similarly, there are like bonds which will pay only the coupons and the principal will be paid at the end, okay, on maturity. These are the non-amortizing bond.